listening to The Mortgage Scientists, exclusively on the Pod Station.
Hi, I'm Dave Forrest.
I'm Chris Hume. Together, we are the Mortgage Scientists.
Another episode.
The remortgage.
The remortgage.
Something we all come across at some point, don't we?
Yeah, a remortgage, effectively when you move it from one lender to another. But you might do some other things around that, mightn't you?
Quite possibly. One of the things that we've seen an awful lot of is people borrowing extra money for home improvement. So it might be a new kitchen or bathroom or an extension or a conservatory, particularly just after Christmas when all the debt's built up that you don't really want to carry. Do get asked about whether that debt can be added onto the mortgage. Sometimes there are reasons to do it, sometimes reasons not to do it.
Yeah, what we call debt consolidation, taking some unsecured debt that you might have, maybe a loan or credit cards, and then you're using the equity in your property to pay that off initially, but you're going to take it differently over a longer term, which initially might mean your monthly costs are less, but over the term you might pay more back, which is what we have to get into, isn't it? It's not just as simple as, well, I want to pay some debt off. I've got loads of equity in my house, I'll do it. A bit more nuanced than that, isn't it?
It is. Certainly from a professional point of view, we've got to consider the financial impact of taking debt that, okay, the rates might be 15, 18, 30% on a credit card, but taking that short-term debt and putting it on a mortgage, yes, the rate might be 3, 4, 5%, but the length of time that that's over on a mortgage can actually mean that you pay a lot more interest than if you just manage that credit card balance down naturally over a few years.
That's something you can consider, and it's something to think about, and you can do it, but I think our job is to make sure you do think about the consequences of it. People do it multiple times possibly, but what's the impact overall? As long as you know that, that's fine and you're going into it. But also it's looking at what debt you're paying off. Say car finance wouldn't probably be the greatest thing to put in because you've got a depreciating asset, haven't you?
Yeah, absolutely. It is looking at what that debt is, what the current cost of that debt is, both from an interest point of view and a monthly payment point of view, and factoring that into current circumstances, income, family, all those sort of elements that spin around in our heads when we're looking at whether it's the right thing to do. And we have to make sure that whatever we do is absolutely the right thing. And if it's not, we need to let the client know that it's not the right thing.
Yeah, it's about best advice, isn't it?
Totally.
You know, what's the best advice? And again, we're coming back to this, is speaking to your broker, getting some advice. Is it the right thing to do? Is it right to do all of it or some of it? Can you put a plan in place to do some of it and then you get the other paid off with the residual then funds you've got? There's so many different elements, isn't there? You might be doing some home improvements and debt consolidation. You might want to do some business borrowing.
Can be tricky sometimes,
can't
tricky,
it? Yeah. Some lenders will do a certain amount. A couple of episodes ago we had our Christmas special and we were talking about worry over getting into debt and stuff like that. So probably this time of year you start to get these queries, don't you? Because we're out of that period. People have had that first credit card bill, the scary one.
The scary one, yeah.
And then reality's hitting a bit, and can we change things? So again, our theme on all of these things is speaking to a broker, having an honest chat, and having a broker who'll talk to you, will
Genuinely.
Honestly give you some advice on it. Certainly from, you know, a broker point of view, you don't want to be, every time a rate change is coming and you're going to see one of your clients and they're saying, well, can I do some more debt consolidation? Every 2 or 5 years, you're going to have to sit down with that client at some point and say, come on, we need to give you some help here. And that might be referring them over to the likes of Systems of Advice. Step change are very good, aren't they, on stuff like that. It's not just about, I want to do it, you're going to do it for me, end of story. It's a lot more complicated than that.
It is, because it's looking at how the debt has arisen in the first place. It's looking at how to avoid that debt arising again, because what you don't want to keep doing is coming back every 2 or 3 or 5 years, adding debt onto your residential home. That is the other side of consolidating those debts that are not secured on a home and securing them on a home. It puts your home at more risk than you actually need it to. As well as the financial impact of monthly payments, interest, you've also got to weigh up, you're increasing the commitment that you're putting on your residential home and putting it at more risk of a lender asking you to leave the keys on the sideboard on your way out if you can't pay that mortgage. And that's the hard reality of not paying mortgages. You will be asked to leave.
And it's looking at every little element, isn't it? Because you might have someone come in with less than a year left on a loan, say. They think, oh, I'm struggling, I want to pay this off. Well, you think if you could stick with it for a year, that loan's going to be gone. But if we're going to put it on your mortgage, you've now got 15 years, say, left on it, or 20. Where if we can restructure things a little bit, we might get you to the point where you have paid it off. off. It's a lot more complicated than just, again, I'm just going to pay this debt off with my equity and do it. I mean, that's sort of the debt consolidation, which probably is the complicated bit. The more exciting bit, like, is people do want to do home improvements. They can borrow money in between, say, a fixed rate ending. Some people think, I'm not going to do that until my fixed rate ends and then I'll remortgage, but you can do it in between, can't you?
Yeah, it's the move or improve decision, isn't it? With the cost of moving house these days, with stamp duty, agents, legal fees, if you can achieve the extra living space from your current home by improving it, a lot of people are actually looking towards that and using the equity that they've got in the home now to borrow against to then get those things done. And that's proven to be incredibly popular with people wanting to improve their homes.
Yeah. You'll sit down with someone and say that we want to do an extension, and they're expensive nowadays. About 10 years ago, it was about 40,000, and now you're pushing 100,000 maybe, to do a decent extension. You'll have your salaries or your income does allow you to borrow this amount. Let's look at that against all the work you're going to do, and you might have to get plans done, architects, all those things. But if you do move, it's speaking to a broker and saying, here's my option. I could buy that where I don't need to do anything, or we can do that. So it's not always a case of, I'm just going to go down there. You can change people's thoughts on things by just showing them the figures, really, can't you?
You can, and like you said before, if you're part way through a fixed rate of 5 years, whereby if you wanted to exit that, the penalty to exit that was too severe, there are ways of helping you borrow the funds that you need during that period of time and avoiding having to pay those penalties to your existing lender. Now, whether that is borrowing the money from your existing lender or another lender through what are known as second charge or second mortgages, your broker can help you understand which is the right way forward for you and how you can actually achieve that end goal of improving your home.
And most lenders nowadays will have some sort of additional borrowing, won't they, where in between, while you're with the lender, you can borrow extra on the top for certain purposes. Now, you might pay a different interest rate. It's not always the fact that you're paying the rate you got, or they might give you a specific interest rate, or sometimes what they call a standard variable rate, which is the variable rate which goes up and down, but is always sort of higher than the fixed rates they have. So again, it's about sitting down with your broker, planning a bit. How can we do this? What options have we got? And I believe if you've got some options, that's the best position to be in. You're not stuck going down any particular route. I think probably we call it remortgage or refinance. You should always have a chat with your broker again if you want to change something. What's the options? What can we do? Again, you're going to have some choices then, aren't you?
It is, and typically your remortgage refinance scenario will usually come about when you're within that 3, 5, 6 months before your existing rate finishes, probably a fixed rate, I will think, from the market we've been in. There are some trackers and discounts out there, but when that rate's due to come to an end, you probably want to avoid dropping onto the lender's variable rate, which are comfortably north of 6% at the minute with most lenders. This is where your broker can help you understand what the options are, whether you want to raise some additional money or whether you just want to keep that mortgage balance the same or even pay it off quicker. We can analyse the differences between staying with your existing lender and just switching a product with them versus looking at the wider market to see if there are any cheaper, better lender options out there, and even possibly changing the mortgage term if your budget needs the term shortening or extending.
We're just going to go to a commercial break. We'll be back after this short message.
Do you have a passion, hobby, or expertise and want to share it with the world? Why not do a podcast? The Pod Station offers a wide range of packages to make this a reality, ranging from training and support for those who have no idea where to begin to podcasters who just need somewhere to host their show. With prices starting at a mere £15 per month, you can now get involved in one of the fastest growing entertainment forms in the world without all the headaches. To find out more, visit thepodstation.co.uk/station-packages. And remember, those with passion, podcast. This episode is sponsored by Dunkin' Biscuits, a biscuit lover's guide by Chris Hugh.
As we stand at the moment, interest rates are falling a little bit from where they've been over the last, say, 3 years. A lot of the time, you can educate people that, well, actually, although we're getting you at a better rate and your payment's going down, in your affordability, if you can continue paying what you're paying at the moment, we can knock 2,
reduce
3,
the term,
5 years off. Tell them what that will save them on interest, which, without being horrible, the lenders don't probably want you to do that. We're there all the time to try and help people understand the longer term view, aren't we? What does that look like for you? Can you get this mortgage down quicker? Or as you say, do you want to extend it? Your family might have grown, or you want to do something.
Yeah, it's a little bit like when you first buy your house. Typically, you might fall into a 25-year mortgage. You're not going to have that mortgage for 25 years. We're generally building that 25 years with almost mini mortgages, and each mini mortgage suits your circumstances at that time. Initially, young professional couple, maybe just the two of them, want to buy the first place. Let's get that on a shorter term. They want to then make the next move. Maybe kids have arrived, there's childcare costs and that kind of thing. They might want to push the mortgage term out a bit. But then as the kids go up a bit and the childcare costs diminish, there's more affordability to pay the mortgage off quicker. Let's bring the mortgage term back in again.
So, I like to deal in a 5-year bubble. I think that's quite sensible, because so many things are going to happen there, aren't we? We would expect income to increase probably a little bit. As you say, kids come along and that changes it possibly the other way. House prices and the value of your house, you would always say, will generally go up. They could go down, but generally we sort of say over time house prices will rise, so that gives you a few more options. That might change your interest rate, lower it if that gets better, but then again you may want to borrow some of that money to do some improvements. So there's so many things involved in refinancing. I know you do it, and certainly I look at doing it, is getting in touch with your client 6 months before the end of their fixed rate and saying, right, should we start to have a look at it? Whether it be a 2, a 3, a 5, even a 10-year fixed. But constant reviews are good, aren't they?
They are. One of the reasons that we get in touch with clients 6 months before is that we've been in a very uncertain rate market. Generally, if we can secure a rate today for mortgages that are expiring in May or June next year, if something happens in this strange world of whatever could happen, if mortgage rates go up again, we've already got the best there is out of the market. If mortgage rates continue to fall, there's opportunities over this next 2, 3, 4 month period to jump from rate to rate to rate, even with that same lender that you have an offer from, and take lower rates as they come up. It's basically getting the best out of all those options from a 6 month period, rather than leaving it to the 2 months before and having to take whatever is on offer.
The beauty of being with a broker is we're monitoring that all the time. It's our life is looking at interest rates, watching what the Bank of England does with their, because that does affect interest rates. Lenders are quite on it at the moment, aren't they? So if they think a Bank of England rate's coming, they may well lower before. They may well do nothing after the Bank of England. I know you'll be the same. If Bank of England rate drops, your phone goes crazy and everyone says, when am I getting a new rate? It doesn't quite work like that, because lenders are sort of on the ball with it, aren't they? But they're always competing, and there's times a year when they will drop the rates or make them a little bit higher for certain reasons.
It does seem to be that lenders are pricing their rates not just according to the market rate as to what they can borrow the money in at, guided by the Bank of England, which is what most people know. But I think lenders are also pricing according to how busy they want to be. So when they're not so busy, they will put out a really good interest rate. All the brokers in the UK will bombard them with applications. Then all of a sudden they get busy and they then put their rates up. It's this bit of a merry dance between lenders as to them pricing to get business in or not get business in, which I think is having a bigger impact on mortgage rates than actually the market rates are.
Well, I think service has a lot to do with, as any company, your service to your clients. And many years ago, you'd have that times when lenders' service was horrendous because they'd had a good rate. There's a bit more planning involved and a bit more technology now. So, they can forecast when they're going to have a spike, but technology takes over a bit, rather than you just can't hire a load more staff one day to do a load more work, where technology does it a bit more. But on the refinance as well, there's other areas, isn't there? There is, if you're going through maybe a separation or a divorce, things need to be changed. The finance side of things is vast in that, isn't it?
It is. Unfortunately, January does seem to be the one month of the year where separations do become more prevalent than other months of the year, where one party wants to buy the other one out of a property. That is something that your broker can help with, because it's a very emotional time from the point of the vulnerability of someone in that position needing that help and that guidance at a time where it's a one-off life event that is really, really difficult, and they need help in managing the financial element.
From that point of view, there's worry, isn't there? But it's almost like the finances sometimes is the last thing. But I think sitting down calmly, talking about it, what can we do, trying an amicable way of doing it from a finance point of view can make things easier. And I think that's where we come in. We can sit down, we can give options again. That might be changing the mortgage, it might be moving it, and there's costs involved. What what can you do? More and more we get involved in that, don't we, with clients when they're going through that.
We do, and financial stress is probably some of the hardest stress to deal with. If you can have someone to help you understand what the financial elements are, someone who's on your side, that is a massive, massive help going forward. But I suppose whatever you're doing with a remortgage or a refinance, if you're looking to move from one lender to another, there are going to be elements to look at. That new mortgage application will look at all of your income, your spending, all that kind of thing. But the new lender will want to understand what the value is of your property, so they'll undertake a valuation. Probably just going to be a fairly basic mortgage valuation. You're not really going to know what the figures are other than hopefully agree with you. Yeah. A lot of lenders will do that for free for you, largely because they'll just do it on a desktop.
As we call it.
But there will also be some legal work involved in moving the charge from your current lender to the new lender. Sometimes it's incorrectly called free legals. It's actually really fee assisted legals, where the lender might pay for the very basic elements of that legal aspect. But if there are other elements, if you're adding someone on, taking someone off, if it's a leasehold property, there may be additional legal costs to think about, but your broker can help you with that.
Yeah, again, that's where we can help with the fees. Is it worth moving? Because those fees become available. You might have a fee to get out of that mortgage if you're in a fixed rate, but you've got to go because the criteria says you've got to move because you can't do it. So there's so much involved again, isn't there? Again, there's the thing, I don't think I can do this. No, sit down with your broker, go through the detail, get what the fees are, and then we can help you.
Yeah, and I think that's again where the broker is there, not just to find a solution that works for you, your circumstances with the lender criteria. It's about them project managing it through from start to finish, dealing with those solicitors, making sure that, if there is an issue with the valuation, following up on where the options are from there and helping you manage it all the way through to that new mortgage completing in whatever time that is. And like you said before, keeping an eye on the rates in the interim. If the rates do come down, let's have a look if we can get a better one.
Get some good advice.
Absolutely. I think that's covered an awful lot on remortgaging and refinancing. There's so many more things that you could do though, aren't there, Dave?
On our emails in the description, you can pop us an email. All our details are in there. You can give us a shout. We'll help you out and answer any questions.
Will do indeed. Looking forward to catch up for the next episodes. If anyone does have any questions that they want to fire over, bob them in and we'll cover them off in a future episode.
See you on the next one.
Will do. Thank you, Dave.
To find out more, email info@themortgagescientist.co.uk.